Right, today we're going to be having a look at dollar cost averaging and the theory behind it, why it plays out, and how you can profit from it, and also how you can profit by using a stop loss and only getting a 25% win rate. Let's get into it. So what is an edge in the market? An edge in the market is when you recognize that based on historical data, prices tend to react in a specific way and come back to certain means and averages over time. So right now, to keep it simple, if you place a buy or sell, there's a 50-50 chance of price going up or down. That's all it does. It's going to go up or down or consolidate. So up or down or just range. And then eventually it's going to go up or down. That's all price does. So when you have an edge with your trading strategy, it means that you can increase your probability slightly above 50%, which is giving you a better chance of making a successful trade and actually extracting money from this market. These are some edges you can have. So this would be with a stop loss using risk to reward. So by using risk to reward, for example, if you have a 50% win rate and you have a 1-to-1 risk to reward, meaning you risk $10 to make $10. With 50-50, overall, you're going to be break even. Now, if you risk $10 to make $20, meaning a 1-to-2 risk to reward, and you have a 50% win rate, you're profitable. So the minimum win rate required now is only 33% if you use a 1-to-2 risk to reward. And then it goes so on and so forth. So the higher the risk to reward, the less win rate you're actually going to need. It sounds easy enough, but using a risk to reward, from what I've found, using a stop loss just hurts you mentally, simply because you just keep getting stopped out over and over again. And for example, if you're using the 1-to-3 risk to reward, you can go on a 3 losing streak, which happens often. So you lose 3 trades and you finally get a winning trade, you make your 1 back, and now that you've done your 1-to-3, you're at break even. You've won the 1, but you've lost 3 trades, so you break even overall. No fun. What I like to use as my edge is waiting for price to go into profit. It's so simple. You just wait for price to go into profit. And I'll show you more in this video how that works. You guys have probably seen what dollar cost averaging is through maybe trading stocks. It's sort of what Warren Buffett does and how hedge funds trade. So they'll average into positions, which will lower their risk and help them get a better price without getting stopped out. So there's nothing more painful than you enter a position and you place your stop loss below the lows and a take profit up here. Price is going to bounce around, come down, hit your stop loss, and then just shoot up to profit. So you just miss that profit because you got stopped out. So dollar cost averaging can help you avoid that. So the concept is pretty simple. We place a buy or a sell on a currency pair by picking a direction in which the market is expected to move. We wait for conditions that historically repeat over and over again, and we place our initial position to see how it plays out. If it works, excellent, we make money. If our timing is wrong, we can manage multiple trades as required until the move completes or pays us. We also don't have to worry about stops, as our positions are in such a small lot size to not care about them. However, we do need to manage our drawdown and exposure as we're in these positions. These are some important rules for when you're dollar cost averaging. So number 1 is you scale in small, because you're waiting for these guys to move your positions into profit when they are ready. You're not trying to time it. So if you enter small, you can just wait until we have that snapback. If you enter too large, you're going to blow your account before we have that pullback. We constantly need to move our entry price with us, so we're pretty much moving the average price of our position with us and keeping it close to the actual bid price. So when we do have that pullback, we just straight into profit very quickly. And last, we need to constantly monitor our drawdown. If we don't do this, we can blow our account. We need to look after our exposure and that we're not risking too much. So obviously my edge is waiting for price to go into profit. This is one of the ways I trade. I do actually also have a stop loss strategy I use for prop firms, but for my long-term sort of investment, making money over time, I do just wait for price to come into profit. Now, I use RSI as my edge. There's a few more confluences, but you'll see later on that when RSI is extended, it's meaning that price is overbought or oversold, meaning it's going to need some sort of pullback to its mean for these banks and institutions to take their profits. So I'm just waiting and I'm riding the waves that they're creating. So I do not have a magical orb that is going to tell me when price is going to reverse. It would be too easy. By dollar cost averaging in, you can catch these moves pretty well though. So let's just see. We roughly know that when RSI is extended, it reverses. We extend it here, extend it here, extend it up here again. This whole line is extended. So this is a pretty good example here. If you start averaging in here, like this, by the time you're at the top, your average price can be here. So we have that snapback we're expecting and we're in profit. So yeah, as I said, we don't know when RSI is extended, it's going to reverse. But we can use this to our advantage and start to scale into a position knowing that we are roughly in the right area at roughly the right time. So we may see price is moving up very, very hard. And we're going to start scaling into this position because the RSI is extended. So we add our first sell here, a second sell here, third sell, and what this is doing is it's bringing our average price up. So if we had one position open, our average price would be here. We add a second position, it's going to put our average price in the middle, and so on and so forth. The more we add up the top, the more it brings our average price with us. So when we have that snapback, we can get into break even and then profit when it does pull back. Since we're not using a stop loss, we're just going to scale in so we get the best price we possibly can without timing the market. So this increases our odds of having a successful trade long term because you're just waiting for your positions to go into profit. You may need to sit in drawdown for a bit longer, but with the right risk management, drawdown control, and mindset, you can be profitable by using dollar cost averaging. Quick little note here, when you're looking at RSI extensions, remember that a higher time frame will give you a more accurate entry. And I think I'll show this later in this slideshow as well. So I bank small profits every day because I'm trading 16 different pairs, or I have my bot trading the 16 different pairs. So it sort of just manages them and enters and leaves, and it banks small profits every day. So I enter the market when it is stretched and I'm expecting some sort of pullback. Currencies move up and down so that these banks and institutions can make their money. Remember from lesson 2, I think. So you just got to wait and you got to surf these waves these market makers are making. Alright, like I said before, the higher the time frame RSI you look at, the better your entries will be. So this is a squeeze that I had on AUD NZD and I actually came out of it profitable. So I believe this is the H1 chart and I got extended over here. So I entered a sell position right there. Price continued to move against me for quite a long time. I'm pretty sure this was about 2-ish months. But I actually ended up making money from being wrong this many times. So added a sell, added another sell here, and then added another sell here. And what's this doing? Every time I add a sell, I gradually increase the lot size, ever so slightly as well. So by the time it reaches the top, my average price at the moment, I believe, was all the way over here. So if I can draw that straight, you can see price did eventually snap back, which was what I was expecting. So it came here and I was break even already after being wrong 3 times. I got out right here. So this trade here, nice profit, bigger lot size, little bit of profit, nice, slight profit, and then a slight loss. Overall, all 4 of these trades were profitable. And that is the power of dollar cost averaging. Now, I'll show you what happens when you look from a higher time frame, how this could have played out better for me. So over the years of trading, I have found that some pairs, such as AUD NZD or Euro Great British Pound are very bad for these squeezes, aka price just moving against you constantly. So this is me looking on a daily time frame rather than a H1. So as you can see on the RSI, we're only extended all the way up here. Rather than on the H1, I entered my first trade here. So we missed all of this mess up by looking from a higher time frame. So we only entered our first position here, second position up here, and there we go. We get out with going in less drawdown and less stress. So this is the power of looking from a higher time frame, RSI, than on a lower time frame. On a lower time frame, you get in more trades and go in more drawdown. So it is more risky. You can actually make more money because you'll be getting more trades, but you'll also be sitting in a lot more drawdown as time progresses. So my approach to trading is that I do not use hard stop losses. I manage risk differently, but I'm still very strict with my risk management rules that I follow. I use small lot sizing and multiple entries for every trade, so I do not have to worry about trying to time every trade. This is the problem. You're trying to time a market that is random by using stop losses. If you try and time it, you're going to suffer because the market is random. It's 50-50. So you can increase that edge of being 50-50 random by dollar cost averaging. I use close targets for price to minimize my time in the market. Some pairs I like to swing, like AUD and ZD. I'm just looking for extensions. And number 4, which is very important, is I use custom indicators and an EA to automate 90% of my trading. So a lot of the time I don't even look at my chart and my bot will just trade it for me. So why should you dollar cost average? When you use a stop loss, it is important that you get your entry as accurate as possible. As a dollar cost averager trader, what is more important is how you manage the position after you take your first entry. Because of this, taking a loss is more of a rare occasion, and this helps with your psychology as a trader. So if you find a long-term profitable edge in the market through back testing and forward testing, you can trade with a decent amount of ease because you know that long-term you're going to be profitable and have an edge over the market. So let's take a look at the theory behind dollar cost averaging. So the theory behind it is what I like to call the elastic band theory. It's an easy way to help you visualize market extensions. So think of the market as an elastic band. If it's not stretched out, it's not doing anything, and therefore you're unlikely to make money. There's no volume in the market. When it's stretched in one direction hard, it's going to snap back just as hard. We don't know when it's going to be let go by the person stretching it, aka banks and institutions, but the more stretched the elastic band is, the harder the snap will be, and you can actually see this. This is a daily chart, and you can just see the elastic band stretched, snap back, stretched, snap back, stretched, snap back, and it moves in these legs. You can see it very clearly. Pause this video, go look onto a daily or H4 chart and see if you can spot this theory in play. So go on TradingView or MetaTrader and just have a look and look how the market just moves up and down. It's what it does over time. And what you'll see is if you draw a straight line across your chart on the daily or H4, you'll see that price often comes to its mean or average as time progresses. So since price historically tends to bounce up and down, we have to wait until we see the rubber band is being stretched before we can even consider entering a position. So once we see the elastic band is stretched, we can enter expecting that snapback. So squeezes do happen. Squeezes being where you start entering positions and price just keeps moving against you. So it's very important that when you enter your first position, you are pretty much expecting a squeeze to happen. AKA, you enter such a small position because you're expecting it to move against you. You're expecting it to move very far against you. So that is the position size and you should use very small. And you scale in as time progresses. You can't scale out without taking a loss. So you scale in very small, bring your average price with you for that snapback. Put simply, my edge is waiting. Just waiting for price to go into profit or come back to its mean. So it's my job to wait for it to move into profit. And if price moves against me, I can just add to the trade. So even if I get into a trade and it moves against me, I'm not that angry because I'm just going to average in. I'm waiting for this elastic band theory to play out. So I'm just waiting for it. It's stretched. I can see it's stretched. I'm waiting for that snapback to happen. When price moves strongly in one direction, it often needs a pullback in order for the banks and institutions to make a profit. This is important to remember this when you're dollar cost averaging. So if you've seen that price is stretched very, very far up, it means that these banks and institutions are long. And when they need to take their profits, aka close their positions to make money, they become sellers because they need to sell their positions now. So what does that do? It makes the market move down. And I'll show this more in depth in, I think, lesson 3, which is what is market structure. So have a look on my YouTube for that. When they do eventually sell at the top and become sellers, other traders and other banks will see this and they will add sells, which will also help pump the price down. Pretty much big banks are closing off their size and flipping their position, and other traders are entering, which is why we see the snap of the elastic band even harder. So we're going to come up pretty gradually and snap. You'll see that quite often. Alright, and that's the end of the video. I have got more lessons coming out in the future, and I do have a fair few videos now in the past, so if you want to check those out, have a look on my channel. And as always, if you have any questions in general or about my EA, my bot that trades for me, just message me on Discord. I'll leave a link in the bio. Cheerio.